Okay, welcome back, guys. So, in this session, we're going to specifically focus on recording of your credit and sundry transactions. So, what does that mean? So, your credit transactions is anything where I buy something now and I'm going to pay for it later. And your sundry transactions are those transactions that does not actually fall into a cash or a credit category based on the type of transaction. So those we call sundry transactions because they don't actually meet the definition of cash or credit. So that is just the extra add-on accounts that we generally have. Now, for this learning unit, the learning objective specifically is to explain why offering credit can be a benefit of a business. So today we're going to look at that. To explain the risk associated with offering credit to your customers. So normally if you provide credit, there is some component of risk and you need to be able to explain what those risks are. Then you need to be able to record your credit sales. So that is sales on credit to customers, your debtors in your debtors journal. Then record duplicate credit notes in your debtors allowance journal. So credit notes is when your debtor returns something to you. Then record credit purchases in your creditors journal. So that is when I buy something from a supplier on credit. Record credit purchase credit notes in the creditors allowance journal. So that's when I return goods to my supplier. And then record sundry transactions in your general journal. Okay, so that is those transactions that isn't really cash, isn't really credit. Where do I put them? I put them in the general journal. And then you need to be able to complete a comprehensive exercise where you record all 8 sundry journals. So normally a question would cover all the journals and not only one specific one. So you need to be able to do that and then account for the VAT in these journals. Now that is where learning unit 3 becomes very important to know whether it's a standard rated supply, a zero rated supply, or exempt supply. And then you account for it similar to what we've done now in learning unit 4 when we looked at question 4.12, and then be able to explain how the rules of debit entry are adhered to when we do a journal entry. So that is exactly what we've done so far. Is if we take the cash one, for example, we said you debit bank when you receive money and then you credit the other columns, and that is your double entry system. So whatever is on the debit side needs to equal what's on the credit side. And that's how you adhere to the double entry rules. And then you need to be able to put it into your general ledger, which is your T accounts, and then draft a trial balance and then analyze these type of transactions in an accounting equation. Okay, so the accounting equation is where we've done an example in class as well. That's where you list all the financial elements category. So whether it's an asset, owner's equity, or liabilities. And then added on to that, you have to add the account names. So whether it's inventory, whether it's bank, whether it's credits control, debtors control, input or output VAT. And that's how it becomes more and more complex. So after this learning unit, you should be able to do all of that. Now let's quickly see how we define credit. So credit is the ability of your customer to obtain goods or services. So we're getting the goods and services now, but we only have to pay in the future. But for that to be able to happen, there should be some element of trust that needs to occur. So the example I've got on the slide is a credit card. That is where I buy something now, but I'm only going to pay for it later. Now, how do people actually make sure that that element of trust is there? What do you think your supplier does before they would provide you with credit and allow you to buy on credit from their store? Okay, let's say you buy an account from Edgar's. What would Edgar's normally do before you are allowed to buy goods from them on credit? Okay, so Bernice says they do a credit check. They look at, and Matome says we look at their credit history. Okay, what other information do they normally ask for? So they do a credit check is one of the things. They also ask for a salary slip. That's correct, Pamela. So what they do is they first look at your credit history. Now, if, for example, you just left school, you don't have any credit history before, so they would not have any credit history to look at. They would ask for a salary slip as well to see, okay, what type of money do you get into your account? They will then ask you, what is your general monthly expenses? To see how much money do you actually have to spend. And then they would extend that type of credit to you. So let's say, for example, you earn a salary of 5,000 Rand a month and your expenses for the month is maybe 2,000. So that means you have a spare 3,000 per month to spend on other stuff. Then they would cap the amount of money they would allow you to purchase in a month to 3,000, for example. Okay, but that's based on your credit history. If your credit history is really bad, they would generally not give you credit, or if they give you credit, it would have a very high interest rate linked to it. So that if you default, then it will increase your account very quickly. Now, what are the benefits of selling on credit? Now, one of it is by allowing your customers to buy now and pay later. So, buying on credit, you can get a business competitive advantage. You give your business a more competitive advantage than someone that's selling on cash because you can reach a wider range of people. Because not all people have money during the month to pay everything cash. Most people pay all of their expenses generally just after they receive their payslip. So that is why if you allow people to buy on credit now, they would actually purchase more constantly throughout the month and then they would settle their account once they get money. But if you require them to pay cash, they will only buy generally at the end of the month once they received the cash. Now, giving credit also helps your business increase its sales revenue because you have more sales more continuously during the month, and it also helps you to get more repeat customers and create customer loyalty. Because if you allow people to buy on credit, then they know, okay, fine, great. I can buy now, pay later. So I can buy more frequently. And then generally, most of those programs also have a customer loyalty link to it that the more you buy, then you get additional discounts, which sort of gets you to come back and purchase more and more and more. Okay, so that is what the benefit of credit is. Okay, now the three most or the biggest risks that you have when you buy on credit is, although it can be lucrative, now why it's lucrative is the fact that because I'm selling it to you on credit, I will get additional fees. So I'm not going to give you credit for free. There would be some type of expense on it. So normally the additional income I would earn is the interest component that I charge on the credit I've provided. Okay, so that's how I make additional money. But that also means I've got to look at the risk. What is the chances that that person won't be able to repay me in the future? Okay, now that's before I even give them credit. Now, if they do not pay me in the future, so they've got an account of 20,000, but now that person comes back and they're like, sorry, I've lost my job, I don't have money, I can no longer repay this debt. Then we write off that account or that debtors account. And when we write it off to zero, we call that irrecoverable debts or credit losses. Okay, so or bad debts. That is when we take an account and we reduce it to a zero balance. But now, because I'm not getting that money in, it means I do not have more money to spend, and that affects your cash flow. So that is one of the biggest risks with providing credit, that if you provide too much credit, you might not get enough money in to pay your own suppliers, and then you will have cash flow problems, which in the end, over a long period of time, will result in your business then collapsing because of the fact that you do not have money to pay your own suppliers. So generally, businesses that provide credit needs to be very careful on how they manage it. So you can't leave a debtor to just sort of increase their account without managing it and following up, when are you going to pay me, and keeping them on a strict timeline of when payments need to be made. Because especially in our current environment, because a lot of people are struggling, you sort of pay your debt based on who screams the loudest. I know it's sad, but that is how a lot of people actually pay their accounts. They will leave your account until you start harassing them for payment, and then they will start paying it just to get them or get you off their case. But if you nice and you're like, oh no, I'll wait another month, then those people will actually not pay you. And by the time you eventually start following up, those people generally don't have any money left to settle your accounts, and then you end up with the second point where you have to write off the debts, and it's irrecoverable. Okay, so you can tell me what happens. Okay, now we're writing it off. We're writing off the debt in our books. What do we do with the VAT component on that? You can tell me, if I'm writing off money I was supposed to receive, what do I do with the VAT when I do that accounting entry? Okay, so let me repeat the question. I've got a debtor. I sold goods of 10,000 Rand to him, but I sold it 6 months ago. Now I phone that debtor and he's like, sorry, I do not have money to repay you. I've lost my job. I do not have any assets. So there's no way for me to repay my debt. Okay, so you've done everything, you tried everything to try and get some money back, but you're seeing, okay, well, it's a lost cause. I'm not going to get that money back. Now I write it off in my books as a bad debt. What do I do with the VAT? Do I have to raise VAT on that transaction? Do you think I can claim VAT for that transaction? What do you think will SARS allow me to do? Okay, so how do you actually answer that? Okay, so Beneath says they don't think SARS will allow you to do anything. Okay, so let's quickly look. Okay, so our original transaction. Let's start with the original transaction. So when we did the transaction the first time around, we would have said, okay, we debit our debtor of 10,000 Rand. We credit our sales Now our sales amount would be the amount excluding VAT, which is 8,996. 696. Okay, how did I get that? I took the 10,000, I multiplied it with 100 over 115. But now it's still not balancing, so the other side would have been credit, the output VAT, so the money I need to pay over to SARS, and that would have been the difference, and that would have been 1304. Okay, so that was our original transactions when I did the original sales transaction. But now what SARS says, if I write off bad debt, so that means I'm not going to get my money back. Then I can claim input VAT. But only if I paid output VAT. Okay, now based on that, we can see in this transaction, we paid output VAT of 1,300 Rand. So when I write it off, we're going to say, okay, so now I credit my debtor because their balance is now going to be 0 with 10,000. They're not going to pay me. I do not actually have a sale, but instead of sales account, I take it to an expense account, which is a bad debts account, because this might happen years later. So I take that 8,696 and I take that to the income statement. So bad debts is an expense account, also goes to your income statement. And then what I'm allowed to do is that same VAT that I paid originally, now I can claim it back because of the fact that I am not actually getting that money in. So then SARS says I can claim it back. Okay. So they say because of the fact that you're not physically receiving that money, now we will give you the VAT that you've already paid over, we'll give it to you back so that you have some cash flow. Okay, and that's how our credit risk, if we write off something as bad debt, would affect our VAT account. Okay, so just make a note of that. They don't clearly indicate this in your textbook, but they do like asking this sometimes. Okay, so just make a note for future reference. Okay, two other things I want us to look at, and then we're going to look at a few questions in your textbook. It is very important to know what is the difference between a debtor, what is the difference between a creditor. They do like asking you to explain these concepts in tests, and students do get confused. Okay. Now, a debtor is someone that owes money to me. Okay, so I've sold something on credit to a customer. That customer owes money to the business, and they are called a debtor. Okay, so if we take this example on the screen, this bookshop sold books to this lady on credit. So she's taking the books on day 1, but she doesn't have money yet. So she's buying it on credit, and then she only pays the bookstore back on day 5. Okay, now this lady or our customer is our debtor, is a debtor of the bookstore because of the fact that we've sold these books to her on credit. Okay, so a debtor is when I sell when the business sold something on credit and that person still owes the business money. Okay, now let's look at what the creditor is. A creditor, on the other hand, is when our business buys on credit. Okay, so a debtor is when you sold on credit. A creditor is when you buy on credit from a supplier. So your supplier is seen as your creditor. That's who I owe money. Okay, so that's the debt my business have to pay someone else. So in this case, the supplier provided stock to us, the bookstore, so they provided books on credit. So we're taking the books now and we're going to pay them back later. So we take the books, and once we sell the books, we generally settle our account with our supplier. Okay, and that supplier is called a creditor. Okay, so remember, when we talk about a customer, it's always a debtor. When we talk about a supplier, it is a creditor. Okay, so a supplier supplied goods that we bought on credit, whereas a customer is someone that purchased goods from our business on credit. Okay, now let's see if we take a whole transaction. Now, normally in a transaction, you will have one party will be a creditor, one will be a debtor. Okay, now let's look at the scenario. The bank provides a loan to our mechanic. Okay, so let's say it's a mechanic. They repair cars, and what they need that money for is they want to buy equipment to fix cars and to repair and maintain them, but they also need office equipment. Okay, now for a loan to be given by a bank, we generally have to put up collateral. Now, collateral is an asset in the hands of this debtor. So that is, for example, I put up my shop or I put up my house as collateral so that I can get that money. But this money I borrow, I also have to pay interest on that money until I repay that loan back to the creditor. Okay. Now, in this case, the mechanic is your debtor because they received something. So they received a loan and they will repay it at a later stage. Whereas the creditor is the bank. They've given you a loan, so they've given you that money and you will repay them at a later stage. Okay. So as you can see in this transaction, you will always, one party will be the creditor, one will be the debtor. So in one entity's books, they will have a creditor, and the other entity, they will show a corresponding debtor, and the balances should be exactly the same. Okay. Okay, before I move on to the discount slides, do you guys have any questions on the difference between a debtor and a creditor? These concepts are important. They do ask you to explain it. And this is actually where you can get easy marks in a test. You guys have any questions on debtors and creditors? Okay, so it sounds like you guys are okay. If you've got questions, you can just stop me or you can just send me a question later. Okay, another thing that's important when we look at credit specifically, you get different types of discounts when you buy on credit. Now, credit, or the reason they bring in discounts is for specific reasons. You get a trade discount, you get a settlement discount. Now, a trade discount is given to a customer generally when they buy in bulk. Go to example to macro and I decide, okay, I need to buy Let's say I'm a grocery store and I sell cleaning products. Now I go to Macro and I buy a bulk order of cleaning products. Because of the quantity I'm buying, I can actually negotiate to receive a trade discount. So to get discount for my large purchase. So you either get, which is called bulk discount, but it's also seen as trade discount when you do accounting. So you can either buy bulk, which gives larger orders, and then I can negotiate the price. You get a trade discount where we give you a discount to try and promote customer loyalty and get more sales. That's, for example, if I go to Spa and they will have certain items on special that week. That is a trade discount, which we try to encourage more sales and to encourage customer loyalty so that people come back to my store. Then you've got a cash or settlement discount. And that is when I physically pay money earlier than when it's due. So I settle my account before 30 days or within 7 days. Then someone would reward me by saying, okay, fine, if you pay me within the next 7 days after your account has been given to you, I will give you a 5% discount. So it is to encourage people to pay me sooner so that I do not have cash flow issues. Okay, so those are the different discounts that you get. Okay, so let's think about a few questions and let's see what you guys think about this. Okay, so the first thing I want to know from you guys, in South Africa, do businesses mainly trade in cash or credit, and why do you think this is the case? You can just type your answer for me in the chat function. Okay, so what do you guys think? In South Africa, do we mainly buy on cash or do we buy on credit? Okay, so Pops thinks we buy mainly on cash. Anyone else? Michaela thinks we buy on credit. Okay, what does the rest of the class think? Do we buy on cash or do we buy on credit? Okay, so a lot of people think credit. Okay, so this would depend on where we are in South Africa, what the answer would be. Okay, so let's say in our metropolitan areas, like in Johannesburg and Pretoria, a lot of people will actually buy more on credit in your big cities. Okay, so generally a lot of people here would rather buy on credit. A lot of people have credit cards. But then if you get more to your rural towns, you would actually see the flip side of it, where people would actually pay more cash rather than be smaller businesses which do not actually provide credit. Okay, but in South Africa, we mainly use credit, but more in your bigger industries or your bigger towns, whereas we would use cash otherwise. Okay, so it also depends on the size of the business. So big businesses would be able to provide credit to their customers, whereas your spaza shops or your street vendors, they will not necessarily provide you with credit. But I did hear last year, one of my students told me they do provide credit to their frequent customers that they do know well, but generally it would be on cash. Okay, so it all depends on the scenario, what the answer might be. Okay, what process should a supplier follow before providing credit to a customer? So what do you think a supplier should do before they actually allow you to buy on credit? Okay, check your history to make sure that you'll be able to pay the credit back. Okay, so yes, that's one of the things. What else can you do? Okay, so they might ask for a salary slip for the last 3 months, or if you have a business, so let's say it's a business that you want to trade with, they will ask for your bank statements because the business don't have salary slips. So they will want some type of evidence of income, and then based on that, they will see. If, for example, it is a small business that have sporadic income, so what that means is every month they do not receive the same amount of money that's coming in. So if it's, for example, a business that sells goods, it will be dependent on the season as well as what's currently happening in the economy, whether they earn 5,000 a month, 20,000 a month. So it will go up and down from one month to the next. So what some businesses might then require is they call it that you get someone that signs on your behalf that if, for example, you are unable to meet your commitments and pay your debt, they will pay it on your behalf. Okay, so for example, for your small businesses, they will require that you put someone else's name onto the contract as well that does have a steady form of income, and they will be then underwriting your debt on your behalf. That if something goes wrong, I'm going to pay for it. Or they can ask you, okay, fine, what asset do you have in your name? Put that up as collateral so that in the event that you can't pay your debt, I can take that asset to settle the debt. Okay, so that's a different way of doing it in practice. Now, seeing you guys are studying law, what legal procedures do suppliers need to take in order to collect outstanding debt? So what do we have to do before we can even get our money out of our customer? Okay, so we can maybe agree on a payment plan. Okay, but before we agree on a payment plan, you would normally have already done other things before that, Pamela. What else do you think would you normally do before you would be able to try and collect your outstanding debts? Okay, let's start with the first thing. What do you normally get at the end of every month if you owe someone money? What's the first type of document they would generally send you? Okay, so a reminder to pay your debt, Melo, yes. Okay, they could also provide you, we call it a statement, or they send you which is a summary of all the invoices that was issued during the month. So a statement shows that person at the end of the month, how much money do you owe me? It shows when the settlement date is, and it also shows the analysis of your debt and how long it has been outstanding. So whether it's been outstanding for 30 days, 60 days, 90 days. That's normally what you would see on a statement. So the first thing a supplier would normally do is they will send you a reminder, or they will call you, send you a statement to say, we just want to follow up on payment. The following invoices was already issued on the following dates, and this is the balance outstanding. Then if your customer, okay, so my lady asked if they can threaten you with the police if you don't pay. Before they can threaten you with the police, they have to actually, they first have to go to the court. So they have to issue a summons and get a court order in order for the police to come and claim or take your assets. The police can't actually arrest you for not paying. That is outside of their jurisdiction. So the first step is normally we give a statement. Okay. Then we have follow-up calls. Now, the reason they threaten people with the police and that is because it's a scare tactic, and that's how they try and get people to pay. But there are certain legal procedures you have to follow before you can actually get the money out of a person. Okay, so you first start with a statement. If the statement doesn't work, then you send a letter of demand. Okay, so that's where you demand the payment of the outstanding debt, and then you tell them in that if they do not pay, then legal action will be taken. So that's when we then go to the courts to get a summons so that we can take whatever assets you have and then also start following the process of blacklisting that person. Okay, if they do not pay us. Okay, now if enough people start following that process, they would generally sequestrate that business and liquidate it altogether to start paying the suppliers. But that is a very lengthy process. So that is why a lot of people eventually write off the bad debt, because even with the summons and the courts, it's a lengthy process, it's expensive, they're not getting their money. And then what generally happens with those people is they disappear. You can't find them to issue the summons or to lay claim on their assets. But what I wanted to get, the point I want to make is there's quite a lengthy legal process for a supplier to follow before they can get their money back if a transaction goes pear-shaped. So that is why it's very important before you even give credit to someone to make sure that they will be able to repay you, or that you get some form of collateral or get someone to undersign their debt if it is a risky investment. Okay. So no, they can't threaten you with the police. It's actually outside of their jurisdiction. The police, however, for example, if you rent a property, the police can evict you after they have followed the full process. Then the police can actually kick you out of your accommodation. Once they've received their court order, then they can get the police to forcibly remove you. So it depends on what type of debt it is. Okay. So the last question is, what does the International Financial Reporting Standard, IFRS, say about writing off bad debt? So do you think in terms of our accounting standards, do you think we are allowed to write off bad debt? Yes or no? And what do you think would be the rule? Okay, so let me repeat. What do you think our accounting standards, so IFRS, says about writing off bad debt? Do you think we're allowed to write off bad debt? Do you think there's specific things we need to do before we can write off bad debt? Okay, what do you guys think? Do you have a thoughts on this, or are you unsure? Just put an emoji there in the chat function so I can see where you guys are at with this question. Okay, so Pops thinks I do not think it's allowed, but maybe in certain conditions. Okay, so in the accounting standards, they don't necessarily say a lot about this, but what they do say is in the event that an asset is no longer recoverable. So before we can actually create an asset in our books, we have to say that it is highly probable. So it's highly likely that I will get money in the future from that asset. Now, debtor, that's the person that owes us money. When we sell the goods to them in the beginning, it is very highly likely that they will pay us in the future. Now, as soon as we get to a point, we've done all of this legal action, we can now see, okay, they're probably not going to pay us anymore. We can no longer show that asset in our books. Okay, so it's not probable that we're going to receive any money in the future anymore. So then it says we call it de-recognizing the asset. So we take that asset out of our books. And to get an asset out of our books, we create an expense because it's money we're not going to see in the future anymore. So that sale we made is no longer actually a sale. So we have to reduce our profits. And then we are allowed to create bad debt. Okay, but only once we have followed all the processes and there's no chance of us ever seeing that money. But then the standard also says, in the event that maybe in 2 or 3 years later, that supplier or that debtor decides, okay, fine, I wasn't able to pay you at that stage, but I'm going to pay you now. Then I have to raise that money I've recovered in the future then as income in my books. So that is what the accounting standards specifically say on that. Okay, so what I want you guys to do for homework, there are short videos on VC Learn covering your credit transactions and explaining that. And then I want you guys we're going to do question 5.3 in tomorrow's class, but I want you to finish. We're going to focus on the credit section specifically in tomorrow's session. But what I want you to do so long for me is go look at the cash book receipts, cash book payments, and the petty cash journals for question 5.3. Okay, so based on what we've done in Learning Unit 4, you should be able to do that. So that is from subsection 1 up to, okay. So the first 3 questions, complete those, and then we'll do the rest of them tomorrow in class and discuss them. Okay, do you guys have any questions before we finish off today's session? If you don't have any questions, you are welcome to leave and I'll chat to you guys tomorrow. If you have questions, I'll be online for the next 10 minutes until your next class start if you want to ask me something in the chat function. But then have a lovely day, guys.